The Retirement Café Podcast, Episode 1, Avoiding Inheritance Tax Traps, with Curt Lee.
Retired or thinking about retirement? You've come to the right place. Welcome to the Retirement Café Podcast. In each episode, we bring you an important conversation with insight, tips and knowledge, all designed to help you live a fulfilling and successful life in retirement. Here's your host, Chartered Financial Planner and Accredited Later Life Advisor, Justin King.
Hello and welcome to the very first episode of the Retirement Café Podcast. In this episode, I'm delighted to welcome my friend and highly respected solicitor, Curt Lee. Curt has over 20 years' experience in tax planning. As well as being a solicitor, Curt is also a chartered tax advisor. And this is what sets him apart. Curt is a partner at Lester Aldridge Solicitors, specialising in the areas of inheritance tax, capital gains tax and trust planning. He is also a trust and estate practitioner, authorised by STEP. That's the Society of Trust and Estate Practitioners. Tax rules in the UK are complex. We have one of the longest, most complicated tax codes in the world, which makes understanding how to interpret the rules and regulations challenging. This is where Curt's expertise comes in. When advising clients, Curt breaks his tax advice into two areas: tax you pay in your lifetime and tax you will pay after death. As more and more people are brought into the IHT net with the increases in property prices, money going into the government coffers has doubled in less than 10 years. Curt discusses some of the strategies you can consider to pass on your hard-earned wealth as tax efficiently as possible. He also chats about how to avoid some of the most common inheritance tax traps people fall into and the importance of ensuring your will is up to date. So, here's my interview with Curt Lee on the Retirement Café Podcast. So, on the Retirement Café today, I'd like to welcome Curt Lee from Lester Aldridge Solicitors. Hi, Curt. How are you?
Hello, Justin. Very well, thank you.
Good to see you again.
Yeah, good to be here. Thank you for inviting me to take part in this.
No, really, I enjoy talking to you about all the issues facing the law and as you get older in retirement, and I think our listeners will be really interested in your knowledge of the law and such things as inheritance tax and that type of thing. So I know this is your speciality. Tell me a little bit about yourself.
Yes, so I'm a partner here at Lester Aldridge, and as well as being a solicitor, I'm also a chartered tax advisor. So I specialise very much in the area of inheritance tax, capital gains tax and trust planning, as well as the usual type of private client work, drafting wills, lasting powers of attorney, and dealing with the administration of estates. Tax is really my primary specialism, and it's an extremely challenging subject because of the complexity of the law. I think that the tax code in this country, we have one of the longest, most complicated tax codes in the world. And because of that, I think it's almost impossible for the ordinary lay client, the ordinary man and woman on the street, to possibly understand what the rules are and what they can and can't do in terms of estate and inheritance tax planning.
So have you always practiced in this part of the law, or and Lester Aldridge is in Bournemouth for those of the listeners who don't know? But so have you always been with this firm? Tell me a bit about your history.
Yeah,
how'd you get here?
I began my career in tax in 1997, working for Arthur Anderson Accountants in London. Very much in the accountancy side of tax first of all, and then I moved down here to Dorset, and I've never regretted moving away from London, I have to say. And it was down here that I continued working in a smaller firm of accountants, and I qualified as a chartered tax advisor. And it was after that, then in 2004, I made the switch from the accountancy side of tax to the legal side of tax. And then I qualified as a solicitor, as a trust and estate practitioner. But as I said, tax is very much my primary qualification as a chartered tax advisor.
You must get a lot of pleasure out of exams.
I've done so many exams. I spent nearly all of my 20s and 30s doing exams. And then when I got to the end, I swore that's it, absolutely no more. I have a life now.
Absolutely. So yeah, we touched on inheritance tax, and obviously you understand the law and tax, and of course for our listeners of the the Retirement Café Podcast are hugely interested in what happens when they pass on. How do they pass their wealth on without paying too much tax? So can you give a bit of an explanation to the layperson about inheritance tax and what it is and how it works?
Yeah, it's a huge question, Justin. I'll try my best. Inheritance tax, there are really two elements to it. There's both inheritance tax that can be applied during someone's lifetime, particularly if they're setting up trusts. And then, of course, there's the inheritance tax that can take effect when somebody dies. Now, the amount of inheritance tax that is actually payable by someone depends on so many different factors, whether they're married, whether they have children or grandchildren, what their assets are, where those assets are. All of these things need to be drawn together and considered in the round. Now, inheritance tax in this country is, as I'm sure many people know, 40%. That's the sort of headline inheritance tax rate. It can be slightly less than that in certain circumstances. But broadly, the basic rules are that each individual in the UK has a nil rate bound allowance of £325,000 per person. They then, in addition to that, may be able to qualify for something called the residence nil rate band. And in a few years' time, we'll get to a position where both of those reliefs, the nil rate band and the residence nil rate band, could be worth up to £500,000 per person and up to £1 million for a married couple, say. So in terms of inheritance tax, it's still the case that most people in this country don't pay inheritance tax. But what we've seen over the last few years, the last 20 years in fact, with the increase in the value of properties, is that so many more people have actually been brought into the inheritance tax net. And the tax take that the government receives from inheritance tax is huge. I mean, in 2009-10, the inheritance tax receipts by the government were about 2.4 billion. And now in the last year just gone, it's up to about 5.1.
Wow.
So it's almost doubled, and that trend is going to continue because the government needs all the tax it can get.
Yeah, sure. So what can people do? Because, I mean, the people might not mind paying the tax, I suppose. They're dead, for God's sake, Well,
It's always slightly odd because, I see clients all the time who come to me and they say they're worried about inheritance tax. And of course, inheritance tax, they're not going to be there to worry about it. Ultimately, it's more of a concern for the next generation inheriting the assets. The best tax planning is always to spend it.
Right.
And I think by the time you get to a certain age, actually the way to look at it is that with every pound that you spend, you're almost getting 40% tax relief on it.
Right.
And it's really only costing you 60p in the pound. That's certainly one view.
Yeah.
And some people do take that view. It's not something that they need to worry about. But for most people, it is, because they've worked hard their entire life. They've accumulated wealth one way or another, and they want to hand that down to the next generation.
Yeah.
And in terms of what they can do, there are actually lots of things that they can do, and there are lots of planning opportunities that they can consider. But as you all know, in your line of business, everything is geared towards the individual and their personal circumstances. There are some things that are common and that everyone can do. Making regular gifts, for example, using their IHT annual exemption, making use of the small gifts exemption, for example. If they have excess income, they can make gifts of that. If they have assets that they don't really use or require anymore, they can potentially give those away. But that's when it starts to get a bit more complicated, and when people require advice, because the tax rules are so complicated. It's so easy to get something wrong. And that's where advice is needed. And that's why people go to accountants and tax lawyers and financial advisors like yourself for that sort of advice.
So where would someone find a good lawyer to help them through this minefield? Or what could they find out for themselves? I mean, some people might have quite simple as estates. They might have less than £1 million or the less than the allowances. So what point do they need to seek advice? What bit could they do themselves? Or what point do they get to the point of, and if they do need to get advice, where do they go? Or how do they find a good lawyer?
Well, to find a good lawyer, I think, a source of information are friends, family, work colleagues. Speak to them and find out who they've used and actually whether they're any good. Now, most private client lawyers who deal with wills and powers of attorney and estates, that they will have a reasonable understanding of tax law, and by and large they'll be able to assist the ordinary type person in terms of inheritance tax. And actually it may be the case that for most people they don't need to worry about inheritance tax planning. With all of the reliefs that are available, relax, don't worry about it. Your estate is not going to pay inheritance tax unless you do something weird and wonderful with it. But I think one of the key messages when you're looking for a lawyer is that if your affairs are not straightforward, if you're perhaps in a second marriage and there are children on both sides, or perhaps your estate is very valuable, or perhaps there are other properties, buy-to-let investments, that sort of thing, anything out of the ordinary, then I think when you go to see a lawyer or an accountant, it's really important to do your research and find someone that has the proper skills in the area that you need. So, yes, there are very many good private client lawyers out there, but for specialist tax advice, I think people should be looking for a chartered tax advisor, for example.
Right.
Now, whether that's an accountant or a solicitor doesn't really matter, but you've got to have that understanding of tax law, because when it comes to giving advice in estate planning, if something goes wrong and the revenue challenge it, you've got to have someone there who knows the legislation well enough to be able to argue it with the revenue. Otherwise, you've lost.
And of course, they're arguing on behalf of the beneficiaries rather than the people who actually instructed you in the first place.
Well, that's right. And they can be very motivated in order to see their parents do that sort of tax planning.
Yeah.
And one of the things that we've noticed over the last couple of years with the changes to the pension rules, for example, that you'll know all about, is that has actually provided a great deal of opportunity for people to do more tax planning with the assets that they've got. They're now able to sort of give away capital assets, and yes, there'll be potentially a loss of income from that, but that can be now replaced with the pensions that they've got, the ability to draw on them.
So, Curt, tell me, what are the things that you see that goes wrong? What's the stuff that you're clearing up?
Probably the biggest thing that goes wrong is, I think, people's understanding of the rules. They don't understand how lifetime gifts have an effect. They don't understand how the reliefs available are applied. There's, for example, taper relief in inheritance tax. I'm always being asked by clients to explain that, because they think that taper relief for IHT purposes is a taper on the value of the gift, and it's not. Taper relief is a taper on the actual tax payable, if any, and if there's no tax payable, there's no taper to the value of the gift. So it's people's understanding. But I think one of the big things that people get wrong is when they give something away and they continue to benefit from it. We've had a case very recently where somebody gave away their house to their children during their lifetime, and they continue to live in the property. Now, there's a piece of legislation called the Gift with Reservation of Benefit Rules that treats someone in that situation where they've given something away, but they continue to benefit from it. HMRC look through it, they ignore the gift, and they treat you as if you still owned it, and they will tax you as if you still owned it. Now, the way around that is to pay a market rent for living in your own property.
Okay.
And some people do that, but this is where it goes wrong. This is just one example of where something can go wrong. They start paying a market value rent for their house, and then they never review it. So 10 years later, when the parent dies, the revenue come back and say, what level of rent were you paying? Was it ever reviewed? And the client, the beneficiaries say, well, no, they paid £1,000 a month for the last 10 years and it was never reviewed. And the revenue will say, well, the market value rent for that property when they died was actually £1,500. And in that circumstance, the whole thing falls down.
Right.
The whole thing is ignored. And we've had a case on that very recently. And it's that understanding of when you're doing something quite extraordinary. So not just giving money, not just giving cash gifts and then using your IHT annual exemptions and so on. But when you're doing something substantial like that, it's really important to get proper advice. I think the other big mistake that people make is that they don't realise when they make a gift of an asset for IHT purposes, that is also a disposal for capital gains tax purposes. And so we've had a case where somebody made a gift a number of years ago of a buy-to-let property that they owned. And there was an inherent gain in that. And they just signed over the land registry transfer, they gave the property to their children, but it was a disposal for capital gains tax purposes. And then the executors then had to go back and report that gain to the revenue and pay tax on it.
Right.
And it's having that understanding. And the reason why going and getting good advice is important is because there are ways to deal with that. There's advice and strategies that can be implemented and used to avoid those problems. But most people will miss them.
Yeah, sure. So, I mean, obviously, I presume, actually having a will is really important,
Yeah, it's so important, and for many reasons. Now, perhaps, the most common situation that I deal with is where you have a husband and a wife and adult children and maybe grandchildren. And a will in that situation can be relatively simple and straightforward. But society now is a lot more complex than that. And a lot more people have been divorced.
Yeah.
A lot more people are on second marriages. A lot more people have got divorced and now cohabit. And those situations really require a very specific and well-crafted will, because to get it wrong opens up all sorts of problems if the person dies, particularly in that sort of cohabitation or second marriage type scenario. That, if nothing else, is the cause of more problems in estate administration that I deal with than probably anything else. And it can be very difficult dealing with both sides of the family to sort that out.
And so once you've written your will, how often do you need it reviewed? I mean, obviously the tax legislation is changing all the time and, circumstances are changing all the time. Tell me more about that.
I think there are a number of circumstances when you need to review your will. One is when the legislation changes. When you're reading that newspaper on a Sunday morning and it says new IHT rules are coming into play. At that point, have a look at your will and can go back and speak to a solicitor and see if anything needs to change. Because many years ago, people were drafting nil rate band discretionary trusts into wills in order to capture the nil rate band on the first death. And then in October 2007, the rules changed and those trusts were no longer strictly necessary, other than in certain circumstances. And now we've got the residence nil rate band that's come in. And again, that has very particular conditions attached to it as to whether you can claim it or not. And again, that will be another reason. So a change in the law is one thing. I think a change in family circumstances is another. When big events in your life take place, then you need to go back and review your will. And the big events are getting married, having children, and getting divorced, and then perhaps having cohabitating with somebody else, or getting married again.
Yeah.
Those big life events are when you need to look at your will.
Brilliant. I've got one last question for you, Curt. How do people balance off, do you think, giving away assets and then also with the consideration that they may have to pay for care? How do you advise people around that?
Yeah, that's very difficult, and actually it's an area where you, in your role as a financial advisor, come into the picture, because I know, for example, you do sort of life cash flow modelling and that sort of thing, and that's really important because that tells a person how much they might need broadly, what they can afford to give away, if anything, and then what to do with their assets. It is a real balance, because on the one hand, people have a desire to do inheritance tax planning, and that means broadly giving assets away. On the other hand, they don't know what's going to happen in the future. They don't know what their care needs are going to be, and it's a real balance trying to juggle those two things. People have a fear and a concern about care home fees, and it's a subject that I'm asked about very regularly in terms of wills and whether anything can be done to protect the assets. And it's a really difficult subject to talk about, because I can sort of understand the desire to try and protect the estate and hand something on to the next generation. But at the same time, and I often have to say this to clients, you need to understand that the local authority will only pay for a basic level of care. And if you don't want to end up in the most bargain basement local authority care home, then someone is going to have to pay for it from somewhere. So protection for care home fees is all very well, but it really does need to be thought about very carefully. And one of the things that nearly always concerns me is when a client comes on the telephone and says, I'd like to give away my house to my children now in my lifetime, in the hope of avoiding inheritance tax or care home fees. And I have to say to them, well, it's very difficult to do that, and potentially unwise to do that. So think about it very carefully. Right.
And just following up there, one last question, I think. I've read about and I've seen people putting together schemes that are, in essence, supposed to protect your assets against care home and all that type of thing. What's your view of these?
I think you have to take those schemes with a pinch of salt. Personally, I don't like them because it means losing control of your assets potentially, and it may not be necessary. And I think there are all sorts of risks involved with that, and you really do have to think about that sort of planning very carefully. And I'm not sure that it works.
Right. So, of course, I suppose the insight here is get some good advice. And if the advice doesn't work, of course, you've got some recourse of action.
Absolutely. That's one of the things about going to a solicitor. A lot of people are worried about how much it's going to cost. But the thing is, if you go down to W.H. Smith's and you buy a will writing kit and you do it yourself and you make a mistake in that, there is no recourse for your beneficiaries. Whereas if a solicitor gets it wrong, they can be sued and your beneficiaries will get what they're entitled to. And it's having that peace of mind.
Yeah.
And it's getting good advice at the outset.
Sure. So, Curt, where can people find out more about you?
they can look at the website, which is www.lesteraldridge.co.uk.
Great.
And then go to the profile page and you'll be able to find me there.
Fantastic. Well, thanks so much for your time and your insight into the world of inheritance tax. And I look forward to speaking with you again soon.
Okay. Thank you, Justin.
A big thank you to Curt Lee for joining me for this very first episode of the Retirement Café podcast. It's always a pleasure to chat with Curt. His expertise is second to none, and I agree that getting advice about inheritance tax for complex estates can be crucial. Not only could it save your estate money, it could also save your beneficiaries and your executor a lot of hassle in the event of any issues or disputes after your death. You can find out more about Lester Aldridge Solicitors by visiting lesteraldridge.com and search for Curt Lee under the Our People tab. You can also call the Bournemouth office on 01202 786 161. You can find the show notes for this episode along with some useful links at theretirementcafe.co.uk, episode 1. Let me know what you think about the points we discussed in this episode. You can drop me a line at jk@mfpwealthmanagement.co.uk, or you can connect on Twitter at JustinKingCFP. Until next time, this is Justin King, helping you feel more informed in your retirement.
Thank you for listening to the Retirement Café podcast with Justin King. To find out more, you can find us online at theretirementcafe.co.uk.